Tiff, we've been working together for about 8 years now, I think.
Yes,
And
been a
you have
long time.
been my go-to lender forever. And there's no one whose experience and advice I trust more. But I keep running into a number of questions. And of course, to start off, what's going on in the market? I can tell people what's going on the sales and activity in the
Yeah.
market, but a little bit more about what's going on the lending side, financial side. Would you share with us a little bit about what's going on in the market, what you're seeing, and what you think it means for people?
Yeah. So from the lender perspective, I would say there's just a lot of pent up demand. I feel like for at least a year, I've been saying rates should come down, rates should come down. Don't wait to buy because when rates come down, we all know what's going to happen. And just due to politics, I mean, there's really no other way to describe it. But because of that, um, they just haven't. There hasn't been a road in which rates have started to really come down. We aren't at the highest point that we've been at. I would say we're near it though. The last month, again, we've seen rates climbing. And honestly, it just has to do with policies and things that we're seeing. I mean, well, the people that watch the news know what those are.
Right.
Um, and I think it's important for people to understand that when rates were kept so low for so long, when we were in the, 2%, 3% range, and we were kept there for a really honestly long time, historically speaking, that those rates were artificial. That was being artificially orchestrated by government policy at that time. And so that did honestly a lot of damage
Mhm.
that it's going to take a while for us to recover from. And the current policies in place are not looking to do that again. And so we're going to follow a more natural pattern with where rates are. 6% though, in the grand scheme of things, is still a great rate. The problem is home buyers now were raised hearing rates were 3 and 4, and they just kind of think that's what they should be, but that's not the reality of what is normal and average in the market. Anything below
Agree.
8%, you're still in a good position with rates and gaining appreciation and equity in your home as you make your monthly payments.
I think it's important that you said, that they were artificially lowered for a good long time because that's absolutely real. And they were artificially lowered for what was it, like 8 years?
Yeah,
And it
it
was
started, it kind of started with what happened in 2008 in the market. We had so much inventory, so many people not able to afford homes. In Utah, I feel like we were pretty lucky in a lot of ways. We didn't suffer the impact of that as much. But from there, they just really started to try and, pump money back into the market for us. And I would say, yeah, I mean, at least 5 years we had government involvement, buying bonds to keep rates low. And I'd have to look at the timeline. We could follow up on
right.
that on our next chat. But there definitely was an extended period of time in which the government was causing rates to be lower than they truly were as the
Sure.
bonds
And
were
I
trading.
mean, to be honest, we were kind of pampered with those rates. Now,
Yeah.
granted, we're not going to get into politics and everything, but there's other
No.
problems from that. But
Right.
for a long time, having, you could get a 2.75 to a 3.5% rate, and that was fairly normal. But in a lot of ways, the Fed and the government tried to keep it at that to keep everything, you know, artificially lifted so we didn't have a crash because we were already getting out of a really nasty, financial economic problem at the time.
Yeah.
And so, getting out of that, a lot of people are worried about, their rates. Why would I buy at 6 when I have a 3? And that's absolutely reasonable. Okay. I totally understand that.
Mhm.
But one thing that I try to explain is when the rates go down, the market floods.
Yeah.
And all of a sudden, everybody goes out, and it becomes really, really hard to be a buyer. And that
Without a lot of
sounds
cash in your hand.
counterproductive
Yep.
because
Yeah.
the rates are good, but there are so many buyers coming out of the woodwork. There's so much competition. And I doubt a lot of people know because they're not in our industry. But when there was a good amount of time where houses were going 30, 40, 70, I even heard one going $170,000 over asking price
Yeah.
because the rates were down and buyers were almost desperate to get into a home and lock those in. So,
Yeah, I definitely had more than one situation where someone was paying 50,000 more than the home would even appraise for in cash, plus their down payment because they needed somewhere to go, they had the money. Um, and so if you're not really, cash heavy, then you're not going to be able to buy in that market. That's what's really nice about the market we're in now. Rates are in the sixes. Everyone can get a pretty reasonable payment with a rate in the sixes. And with Shay's awesome negotiation skills, you can even, I mean, we can truly buy with zero down and get earnest money back. I mean, if you have $1,000 to throw at earnest money, and you're fine, I can even get part of that back at closing, but we're able to negotiate that. There's not been many times in the history of the market you can truly buy a house with no money, like
right.
no money.
No,
But
it's
we're in that right now, and so it is an opportunity. Now, I'm very careful to say a lot of people, I'm saying, okay, get in if the payment works for you. That's the thing to know. I feel like a lot of buyers right now are being told, oh, just get in because we'll refinance. I can't guarantee that to anyone. I've been feeling like we're due for an improvement in rates for at least a year now. And I've stopped saying it because I'm nothing if I'm not my word. I care so much about telling people and guiding people the right way. And so
right.
I honestly don't even tell people that anymore. Like, you have to be comfortable with where you're at now. Yes, we hope. Yes, we know that when rates come down, we can refinance and save money for you. And it's a very real possibility, but we need to be okay now. Again, though, if you're, cash light, but you feel like that monthly payment works for you, there's honestly no better time than now.
Absolutely. And like you were talking about with rates and refinancing, one of the things that, we can do and we've been able to negotiate quite a bit is a rate buy down. And
Yep.
that's still absolutely, something that we can get done. But like you were saying, you have to be careful because it's not a guarantee that rates will go down. We've been expecting them to go down for a year and they haven't. So if you've got that 2-1 buy down or 3-2-1 buy down or whatever we would do after
Mhm.
that first year, that rate that is lowered because of that buy down that we negotiate goes up by 1%, which will of course, impact
Yeah.
your payment. We'll assume $400. It depends on the
Yeah.
mortgage, but
Right.
it's pretty reasonable to think that that mortgage will jump $300 to $400 a month.
Yeah.
So if we're gonna do that, that's fine, and we can do that, and it's wonderful. But you
Yeah.
need to truly prepare yourself financially for that next year, and honestly plan for that rate buy down not to be there. Take that extra $400, put it aside, put it into equity, whatever you need
Yeah.
to. If you don't need it when the rate goes up, fantastic. That's fun money times. Buy down your mortgage, you know, do,
Absolutely.
redo a room or something like that. But planning ahead for that is very, very important financially. And like you personally, you are my go-to for many reasons, but one of the reasons is you truly care about the people that we work for, that we help get a house and a loan for. So it's no wham bam, thank you, ma'am, get a loan, get paid, and move on. You're
Not at all.
actually there to, truly care about them and, give them your honest opinion and what you're looking at to avoid them having, future problems.
Yes,
So
I really do care about our clients, and I feel like they know they can call me no matter what. I had one of our past clients actually call me this week. Their mortgage payment had jumped a lot. And I was like, what's going on? We were digging into it. We were trying to figure out. And their home insurance had gone from $1,800 a year to $8,000 a year. And their home insurance agent hadn't even notified them of that or made them aware of
I
it.
got that same call.
So I'm calling all my insurance people. I'm sure. I mean, they're not even. I haven't done their loan for 3 years,
Right.
but I'm out shopping insurance for them. Like, I'll do anything for my clients, even if it's not directly related to what I can do, because I don't want anyone's payment going up $1,200 all the
Right,
time.
absolutely. And I'm glad that we were able to jump in and help that particular person. She's wonderful.
Client for life. It's always just the way I see it.
Yep, I absolutely agree. Now, one other thing is for people that are owning a home at like a 3%, 3.5% rate that really aren't happy in that home, but are worried about it and going, they want to move up or down, whatever it is, their next home, but they're worried. It's kind of like a golden handcuff situation.
Yeah.
I'd love to get out of this and get a new house, but that interest rate is really hard to, swallow. I usually find that pain point even before we go over numbers on what that payment would be, simply because of the sheer number on that interest. And it's a valid concern for sure. What
Mhm.
would you say to someone that was in that situation?
So there's two ways I typically look at it. One is depending on when they bought, all those low rates have really helped appreciation. I mean, for the most part, homes have just gone up, 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 up in value. I have seen a little struggle in a couple areas of people who have bought townhomes in highly concentrated new construction areas where builders are still pumping them out. Like
Right.
that might be the exception. I ran into it twice this week where they don't have enough equity for it to make sense to sell that home. But in the future, it should resolve and they will, gain back some of that. So the first is if you have a lot of equity and you can sell and get $200,000 and put it down, the rate doesn't honestly matter. I
Right,
can
because you're
I can usually
financing so
equalize
much
that
less on
payment.
the
I
new.
mean, and you're getting more house and that works out,
Mhm.
right? So that's scenario one. And we always look at that. If you're in that position and you bought 5 years ago, then you probably do have that much equity and we roll it in and you're good. Especially if you're not looking to be a landlord. That's definitely the way to go.
Right.
But option two that I've actually helped quite a few people complete is that you rent out your current home. So we can use rents. They change this guideline quite often with Fannie and Freddie, and I feel like it kind of ebbs and flows with how solid they feel like the market is. But we're still in a spot where they feel like the market is strong enough that you can use rents immediately, just with a signed lease. So you go find someone who wants to lease your property. You can set the lease out a month or two in advance. So it gives you time to get your stuff out and move. The only kind of downside, and I don't even know this necessarily a downside for most people, you do have to have 5% down. So when you're buying a subsequent home, you can't do FHA again, unless you're moving more than 100 miles away. And it will be a conventional loan and you need to do 5% down if there's not a first time home buyer on the new loan. So essentially we can rent out your current home. We can help you find out what that'll rent for. 75% of that we're able to use as income to offset the mortgage on your current or to help you qualify for the next home. But with a 5% down payment, which can be gifted from your favorite uncle, it can come from 401k, of course, your own savings account. Like there's lots of ways to kind of be creative and find 5% down. But with that 5% down, you can buy something else, still qualify and keep that rental and kind of supplement your new mortgage payments. So I mean, you have that low mortgage at 1,500 a month and you can rent out your place at 2,000, you have 500, in cash flow to help you kind of swallow that payment on the next loan with a higher rate.
Absolutely. I've actually been seeing that where people have a payment of about 1,500, but that house will actually rent for 2,600 to
Oh,
three
I'm sure.
thousand dollars a
Yeah.
month. So even at the 75% of that going in, you're income positive on that. And the house is no longer really a liability, but now it's another asset.
Right.
Now, of course, you do have to worry about, being a landlord and things like
Just
that. And
get
if
the
you,
right people. Don't do what I do and just get in a hurry because it's burned me a couple times.
that's exactly right. And
It's raw. It stings.
there are new rules coming up for property management where you have to be licensed for it, and that'll be coming soon. That's a whole different thing, and we can
Yeah.
always talk about that. But
Yeah.
if it's your own home, I believe the case is still you can do that without a problem. It's just multiple
Yeah.
properties and things like that. But
Yep.
I think those are both good options to, you know, take the equity that you have, whether you're taking a big chunk of it, selling it and putting it on the down payment and simply financing less, which would give you a similar payment or even a lesser payment, even at these rates on the
Yeah.
home that you truly want.
Yeah.
or renting that out, getting that income from that, getting the new loan and actually appreciating on two different properties versus just one.
Here's another thing I've actually helped two clients do, and it's really for someone who's wanting to build that real estate portfolio and is interested. But with both of these clients, they kept their current residence and they rented it out. And then they actually went and bought a home that had an ADU built in. And so not only were they receiving rents on the home that they departed, but they also had rental income coming from a basement apartment in one. And in the other scenario, they bought a duplex. And so they really didn't have a mortgage. Like they had
That's
enough
awesome. That's
income.
kind of living for free. That's house
Yeah,
hacking.
yeah,
That's
they're
wonderful.
covering their mortgage and they have an ADU covering the other part. And they've changed that guideline again too, where we can use rental income as long as it's a legal ADU and there's comparables the appraiser can find to support rents for that ADU, then you can use that to help qualify too. So this last one we closed, I mean, on paper, if we would have just done debt to income, with both mortgages, it wouldn't have worked. But because we're able to use rents from two properties, essentially, we got them in, and they went from their 2-bed 1-bath condo, with a kid on the way to a 5-bed home. So
That's
it
awesome.
was awesome.
Wonderful. Well, I really appreciate that. I want to make sure to do this more often because I think this is things that people are really concerned about and can help them ease some of that fear, some of that concern, and just not knowing what's going on and just help them feel a little bit more comfortable, whether they're looking to buy or sell or not, but just in the market as a whole. So I really appreciate your time.
Absolutely. Thanks,
Perfect.
Shay.
You're welcome. Thanks so much.
See ya.